This is Trepp Wire with a special podcast, The Economic Impact of COVID-19 on Commercial Real Estate. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today is Fritz Kaegi, Cook County Assessor and CRE valuation expert and former portfolio manager. He has a long resume that's very impressive. So I'm sure we'll get into a lot of that. Fritz, welcome.
Thanks for having me on, Martha and Joe and Manus.
Our pleasure. If you wouldn't mind, give us a quick overview of your experience and your background in commercial real estate so that our listeners have an appreciation for it.
Sure. So I came into it because I was on the buy side on public markets. I managed the Columbia Acorn Fund, which is a $5 billion mutual fund. Our assets were at one point up above $10 billion. And we were major owners in listed REITs in the United States. We were one of the major owners in Extra Space Storage and EDR, Student Housing Company, Federal Realty Trust, Equity Lifestyle. So we really cover the waterfront. And then further back, my investing career was on the international side at my company. And we were also big investors in REITs that be listed in Japan, J-REITs in Singapore, and elsewhere. I think I come in as a chartered financial analyst and being focused in on all the different approaches to valuation that folks in real estate might take. I think it helps to have that perspective.
Well, you've got some CFO company here, or CFA. Sorry, that's a different podcast. Sorry.
Yes, over beers maybe.
Yes, former. What is it called? Sadists? What is it called when you like to punish yourself? That's what it is.
That's masochist. Sadist is when you give pain to others, which CFAs also have been known to do.
I hope we're not doing that on this podcast today.
So you have a jurisdiction of Cook County, which covers the greater Chicago area. So in addition to Chicago, it covers 3 sections of about 38 towns. If you could give our listeners an understanding of the demographic and potentially the scale of that jurisdiction.
Sure. So Cook County covers all of the city of Chicago and a lot of its near-in suburbs, and really quite a wide extent. We have 5.2 million people, so it's bigger than half of the states. It has 1.8 million properties in it. It's the largest market-based assessment jurisdiction in the United States. LA is a bigger county than us, but they have Prop 13 there. So assessments are locked in. What we have to do is we have to estimate the market values of those 1.8 million properties. And so it's very important to make sure for the operation of our property tax system in Cook County. And the stakes are even higher because in this state, we're dead last in funding schools from income taxes at the state level. So all the localities depend on property taxes to finance themselves.
Can you explain that Prop 13 concept a little bit?
Yeah, so in California, before Prop 13 was passed in 1979, they had an assessment system like ours. Market-based, you'd have assessors valuing properties, but in the 70s, we had a lot of inflation, a lot of appreciation in home values in some case, and it pushed people out. And so they passed a referendum in 1979, which locked in assessments at the purchase price. And then it would go up a couple percentage points per year. I think it's maxed out at like 1 or 2% per year. And that can create really wacky dynamics. My aunt, she was lucky enough to buy a little cottage in Brentwood back in the 60s, and her property tax bill is low. The person who owns the identical cottage next to her down the street could pay a tax bill 40 times as high because they bought it later. So that's the way it's set up in California. Makes it easier for the buyer, for anyone who's doing the math on locking in rates in California, but it makes it harder for new entrants. That's kind of a barrier to new construction. The way our system works in Cook County is we estimate the market value of things now.
I did see that the Golden Girls home in Brentwood hadn't sold since 1955, and this year went for, or last week, $1 million over asking, and with a $4 million price tag. So yeah, I think there'll be a reset there.
Right. So that's a perfect example. I'm going to guess that the tax bill on the Golden Girls house was couple $100, and it's probably like in the tens of thousands now.
And now can you talk about how it works in your jurisdiction?
So in our jurisdiction, the thing that's a little bit different from a lot of the rest of the country is that in Illinois, we lock in the amount that's to be collected every year. In Cook County, it's about $15 billion of property taxes. And then the rates float. And so the amount to be collected is $15 billion, and the rate is determined by dividing that $15 billion across all the assessed value on different jurisdictions in the county. So in a lot of other places, you have fixed millage rates. That makes it easier to underwrite, but it can lead to property taxes collected to rise a lot. The way it works in Illinois is there's a lid on how much property taxes can be collected each year. But then how it's divided up amongst us depends on the market value and the rate floats. So that makes it harder. To underwrite. So this is what we're trying to fix as we try to fix the system. We want to make underwriting as easy as possible.
And do you guys reassess every property every year, or is this something that's kind of rolling? Every couple years, every property will be reassessed?
Well, the optimal way, I think, would be to reassess everything every year. But the way it works under the state code and the way we work with our capacity is we reassess 1/3 of the county every year. So last year we reassessed Cook County. We reassessed the north part of Cook County. That's the North Shore suburbs. That was the first third we've done. Now this year we're doing the south suburbs. Next year we'll do the city of Chicago. And then there's an additional lag in how it affects your property taxes. So really there's a 4-year baked in phase into the reforms that we're doing here in the Chicago area.
And do you have any sense, I mean, I know you do, but what's from ballpark resi versus commercial in terms of assessed value at this point? Where are you guys at in Cook County?
Sure. Across Cook County, it would be on the order of low 40% commercial, and then the rest would be residential. And industrial is a tiny piece. It's like 1 or 2%. And it's very different across each community. So you always have to remember that Chicago is this big, giant property tax base, but some of those suburban communities have really narrow bases. And so one of the hardest parts of the workings of this system is that in some suburban communities where there are very little property value to speak of, the rates can be very high. We have rates that are 4 or 5 times as high as the city in some suburbs, which is an absolute wealth killer. These tend to be communities that are majority Black. It's one of the disparities that comes out of the way we finance schools, because even if we get assessments perfect there, if there's no property value across which to spread this fixed amount of cost of paying for schools, you get rates that are very high. And that's why people think I like property taxes, because I'm the assessor. I don't. We can talk more about how code really accelerating trends that have been in place, and the property tax is this relic that comes from the Domesday Book with the Norman invasion of England in biblical times. And guess what? The economy isn't based on bricks and mortar wealth anymore, and it's moving more and more away from that. Yet this ever slendering shoulders of bricks and mortar has to pay the cost of our rising educational costs and the disparities in them. And that is really inefficient. I think it's becoming more glaringly inefficient over time.
So do you see your kind of medium long-term goals as changing these rules, or more in terms of being better at executing on the rules as they are now, and being more efficient, more transparent, and everything else?
Yeah, I see it as twofold. So first of all, on the assessment side, our job is to estimate the market values accurately, uniformly, without giving favor to anyone. Because as you can see, if the total amount of money collected is fixed and it's just dividing up the pain amongst us according to market prices, you don't want some to have a built-in advantage or favor over the others, because it comes at everyone else's expense. And usually it's going to be people who are not wealthy, who are racial minorities, or not powerful, or small businesses who pick up the short end of the stick there. So my goal on the assessment side is to get that right, to have it be accurate, fair to everyone, and be predictable. So that's on the assessment side. And then, as an advocate for this crazy quilt of how we finance, that $15 billion, which I don't control how much money has to be collected, but I sure can be the advocate saying, hey, this is crazy when we have these disparities. We need the federal government is best situated to be sharing more of the burden of education, especially when it has the best perspective on how our economy is evolving towards high tech, the kinds of things that we're doing on this podcast right now. And we don't want to hurt the things that make our communities interesting, that hurt people who stay in place and create communities. The more weight you put on the slender shoulders of bricks and mortar, the more you push people out, the more you turbocharge segregation, the more you make it hard for the businesses to survive that make places interesting, that you guys have talked about so much on the podcast from all the places you go around the U.S.
So before COVID kicked in, what would you say your biggest challenge was in your role? Was it something technical, convincing people that the changes you wanted to do were important? Was it political? Was it lack of resources? Give us a sense of what you were up against in your first year as the assessor of Cook County.
The part of it is behavioral. Our system had been dysfunctional in Cook County for so long that we'd become this kind of grotesque anomaly where our assessments had no earthly relation with market values that people could discern on this earth. And then a whole bunch of behaviors had come out from that. So you had pretty much, a great proportion of people appealing, like a third of all the property owners appealing, whereas in most jurisdictions like ours, maybe only a small single-digit % of people would be. Changing behaviors like that takes time because you have to build trust. This is, human society takes a while to evolve. But the bigger, more immediate need is data, and data of a couple different sorts. So to get assessments right, we need good commercial data. And that's to understand what are the different inputs to operating income and also to vacancy and to cap rates, and across the wide, incredibly diverse universe of properties and jurisdictions in Cook County. That's important for commercial property. And then on residential, we find that we have a lot of characteristics that are out of date. And those data gaps tend to have a pattern of favoring certain kinds of property owners over others. So we got to fill in those gaps. And we are really big users of Trepp because of all the different data inputs that you guys provide. We use other sources, and we're trying to build our own. We think one of the best ways for us to get this right on commercial property is to have folks submitting data to us as they do in many other jurisdictions, the basic inputs of operating expense and rents, and so then we can figure out what cap rates are when deals happen, and then to build that into our assessment so that we can show our math, we can show people how we're getting to our numbers, and then the folks like your listeners can underwrite better. It's less unpredictable. We think that our system's been so unpredictable in the past. You had all sorts of hedging behavior that destroys value for current building owners, for buyers. It hurts investment, it hurts renters, it hurts market makers. The more predictable we can make it, the more underwritable we'll make it, that the more cap rates fall, the more spreads fall, the more value is created for everyone. And that's, we think, fixing the assessment system gets us there.
Well, it seems like you're making an impact, because I was on the phone yesterday with a major property owner in the Midwest who was saying that they are using data more than ever because they're finding people like yourself much more educated and data rich than they were 4 or 5 years ago, that this has become the best practice. And too often in recent years, they've been walking into meetings unarmed, if you will, not knowing as much as, at least formally, as the assessors did. So it seems like both sides of the equation are really digging deeper, in your case to kind of modernize, and in the owner's case to make sure that they have the counterpoint to whatever data you have.
Yeah, I mean, we're basically trying to think more like buyers would, like buyers and sellers would, more of a market mentality. And I think the way assessments have been done in the past, at best, it was sort of the way an old school appraiser might work, but missing elements of understanding public markets, missing understand all the insights that you get from the different debt markets that you have a perspective on, and understanding that these asset classes are changing. We have conditions that are changing. We need to replicate what's going on in the market if we're really going to be using market values. I mean, it's not a perfect comparison, but I'd say it's sort of like you'd see with the sabermetrics revolution in baseball, the Billy Beane dynamic, where you have more people who are coming in who are more comfortable with data science and statistics and using different kinds of market insights to one that had a lot of rules of thumb, but maybe weren't the best use in our jobs.
So along those lines, are you a Cubs fan or a Sox guy?
I am a White Sox fan. I grew up on the South Side, and actually, so I'm a confirmed Catholic, married a Methodist Cubs fan, and I trade my children's souls to make them White Sox fans because I'm raising Methodist White Sox fans. We just had a really good series this week against the Cubs, and the White Sox offense is awesome. It reminds me of like the '82 Brewers and the Harvey Wallbanger.
Well, you've had a great start to the season, 5 games over 500 and right in the thick of it in that American League Central. So hope they keep it going.
One of my classmates at college is the GM of the Twins, Thad Levine. So they have a good team too. So we'll see how we do. But it's nice to see the Sox doing better this year.
Excellent.
So you came in on a platform of reform a couple of years ago. And since then, obviously, you've got some critics in Crane Chicago Business. There was a quote that said that the average commercial and industrial property tax bill was up 15.8% over last year, while residential tax bills were only up by 1.1%. Some say that's inevitable. Help us understand what happened there.
Sure. So we're estimating the market values of properties, our predecessors were they showed patterns of not doing this well, and there was a pattern of giving favors to some over others. I'll give you an example. They were valuing self-storage facilities using a 16% cap rate.
Wow.
We were one of the biggest shareholders at Extra Space Storage. I don't know if the dividend ever got above 4 there. So I tell people, if you can find me a self-storage facility that can have a 2 handle on the cap rate, show it to me and I'll listen. But we saw a lot of things like that in the way certain kinds of properties were valued, and we're correcting that. We're representing what's going on in the market. Big apartment buildings in places like Evanston, which is a near-in suburb, but a very well-off one, sort of like you'd have in Brookline outside of Boston or Alexandria outside of DC. They don't sell for cap rates in the double digits. And that's what that's what our predecessors were assuming. And so, we use data. These kinds of tools help that. And that's why you saw the shift towards commercial and share of the pie to the favor of residential, not because we had an outcome in mind, but because this is best representing what the market is paying for these assets, and we're using uniform methods showing our work how we get there. And we always ask people, show us where we've got this wrong. We can make mistakes. We're happy to own up to them, and that's why we put all of our evaluation code online. We put it on GitLab so that people can see how we get to our numbers. They could replicate them. We know there's been a lot of distrust in our system before, and so we wanted to do that. But that would be the mix. And of course, some building owners, they don't want to do that. And so we understand that they don't want to pay more, but they are also well served if we hold the line on everyone, because if there's a commercial property owner who has been underassessed, but lots of other property has been underassessed too, their share of the pie might not actually grow by as much as they think. And I think that's what we saw during 2019. Initially, people shocked with assessments growing, but then they realized, oh, the overall size of the pie is growing too, the base is growing too, so my tax, even if my assessment doubled, it wouldn't the tax wouldn't double. It might only go up 16%. And so we've had more recognition of that. We had a market analyst day last year where we gave people a tool to help underwrite better, to see these relationships, and we think that's had a good benefit for people in the market. Now we're in COVID, so that makes it even harder.
Well, I have my checkbook right next to me, Fritz. If you see a self-storage facility out there being offered at a 16% cap, I'm in.
I'll buy it at 15.
I'll buy it at 15.
You and me, brother.
I'll bid up. I'll outbid Manus and buy it at 15.
Yeah. So I just love listening to the show, you guys, because a lot of the insights you have on the CMBS market are really useful now as we look at COVID, because we're the first jurisdiction in the U.S. to take on COVID in our valuations of properties. Most other people are waiting till next year. The timing happened to work. Our property tax code this year allowed us to take into account COVID, and what we're seeing in CMBS with the delinquency patterns that you guys report on helps us to see where the most pain is. We look at public markets also to give us insight on this. Now other states like Louisiana and Washington are trying to follow our lead on this, but I'm a dedicated listener of the pod just to get a sense for what's going on.
That's great to hear, and thank you for those kind words. On the side of valuation, what we started to see in August, not surprisingly, was the reduction in value of many hotels across the nation. And that's not unusual during times of distress where you see a $100 million hotel see its value cut to $70 million, and maybe that's above the loan balance, maybe it's not. And certainly that will influence whether or not the borrower gives back the keys. In Chicago, we saw the Palmer, which had its value cut in the last 30 days sharply, just as an anecdotal piece of data there.
How much was it cut by? Just I'm curious to know.
I believe it was 500 million, and now it's like 305, something like that. It's slightly below the loan balance of the senior note. The senior note's about 328, if I remember correctly. So my question goes to, the ground is shifting under your feet very, very quickly. Hotel owners could make the case that, our value right now is off 35%. But there's only limited data right now to underscore that. How do you handle the changing landscape as it is right now?
Well, great question, because you're right, there is a dearth of transactions, which makes it hard to do. I find this is where having a look at the public markets helps to give us a sense of this. So, we had to pick a date cutoff to take into account COVID. We used the end of April. And when we did the cutoff at the end of April, public markets were discounting enterprise values of lodging REITs in the neighborhood of 30%. And so, I think the public markets are saying that that is, if the public markets where people are trading every minute of every day, you have two sides of a transaction, very liquid markets are saying that. That's a pretty good data insight, and the dynamics of lack of travel, of vacancy, of COVID affecting behavior is kind of a national phenomenon, at least from urban areas. So I think reading across from public markets, which is not always the best thing to do, but is one of the, you should have a good reason why you're not using that kind of insight. There will be some transactions that we can look to. We will take note of, when servicers are making valuation changes like that, that helps us. Now we're all probably a little bit in the echo chamber of they're probably looking at the publicly traded REITs too, to come to that kind of magnitude of change, which sounds like it's a little bit bigger than 30%. But that's a good example where public markets can help us when we don't have those transactions to work with. On residential, it's like single family homes. We can look at the single family REITs, but also the federal regulators have done a lot of development of unemployment models to value single family homes, and we've looked to some of those as we do that work. It's the public market view on what's happened with commercial real estate is really interesting because you guys have observed that certain kinds of assets, their delinquency rates haven't gone up that much since the onset of COVID. apartments and offices, for example. But the public markets actually have chopped a significant amount of value out of office. And I think what they're saying is that the leases are money good, but re-ups of leases will come in at lower rates and there could be more vacancy. And so that's where, we will tease it out in different variables, but I think having a public view on this helps. There's some, public markets are also saying that certain kinds of assets haven't changed in value. Data centers, lab space, some kinds of warehouse space. And I think that is a very useful signal too. Right now we're reassessing the south suburbs of Chicago. We'll reassess Chicago next year. And at our market analyst day in December, we'll show where we think we are in terms of what we're seeing in public markets. And we've also created a form which we actually adapted from New York. We're big admirers of the assessor there. They have really good commercial data collection. We created a form so that any kind of property owner could submit information about what's going on with their business in terms of rent trends, occupancy, vacancies, and cost ratios. And we'll talk at our market analyst day, we'll talk about what we're seeing in the Chicago area, especially in the city of Chicago, during the year that will inform our assessments next year.
So Fritz, I have to ask the question. You came from a multi-billion-dollar portfolio management position. You're a CFA. You've had very, very long and storied and interesting, great resume, right? And now you come into a job as a public servant with the tax man, essentially, right? Yeah, with many people probably not very happy with you in your former circles. What made you do this?
Well, it's not that I didn't love my old job. I love my old job. I love managing money. I love traveling around the world, getting to meet other people who run businesses and the intellectual challenge of valuing them. I love the people I work with. But, I see myself as, I grew up here in Chicago. I saw that the way our assessment system had been managed in Chicago was creating great damage. It was damaging communities because you had so much unfairness in the system that it was depopulating neighborhoods, hurting people's savings, very unfair. And that other places in the US were doing this well. And that I thought, it'd be I would enjoy and I would relish the chance to use my experience and valuation skills to perform a social good in an office, which is basically about valuation, but it's also about equity, and do that in my hometown and help 5.2 million people in the process. And I thought, this is good use of my life from here. I tip my cap to all the folks out there getting their asses kicked in the market, and I like that too. But it feels pretty good to use the things that we've learned as a public servant too, and to talk about the things we've talked about today, which are pretty technical and nerdy, but go right into the job.
That was a terrific description and quite a noble one. I love to hear that riff on what brought you in and your desire to make your hometown better. Count me in if there's Fritz 2024. You got me. If you want to take your gig national, I'm on board.
All right, Manus. Well, I know you guys will be the first to know because I'm with my people here.
And for all those property owners out there who are listening, we're just saying this because he's on our podcast, okay?
All right, there we go.
Oh no, I'm all for guys that want to reform and do the right thing and
the goal here, right?
City great.
The goal here, just to make it really simple, right, is that if you properly assess all properties, right, including commercial, then hopefully the residential won't have to bear as much of the burden as in the past, right? And maybe you'll lose fewer people to neighboring states.
Yeah, that's right. And so that's the first key to that. And remember, the other oar in the water is taking the load off of all property owners by, let's get another financing tool for our educational system, which drives property taxes so high in the state. If we have more federal financing just for disadvantaged students, it's not a large amount of dollars. We spend $15 billion in Title I spending. If we took that up to 50, you'd see property taxes levies go down by as much as a third. In some communities, you'd see disparities falling. You'd see drivers of segregation going down. And that's not a lot of money. I mean, we gave $50 billion to the airlines this year, and they're already laying people off. I mean, that's how much they spent on share buybacks over the last 5 years.
20,000 just today from American.
Yeah, I saw that, and I feel for them. But let's keep a sense of perspective here on how many tens of millions that if we had just a little bit more federal funding for schools, it would have take the load off of all those people out there who enrich our communities through their presence and owning business and creating business. So I see the assessment side and the levy side both being very important.
So turning our attention away from assessments and real estate specific, tell us what it's like on the ground now in Chicago, the likelihood of restaurants opening, bars opening, people going back to work, schools.
Vibe check. This is a vibe check. We do it with all of our guests. What's the vibe?
Well, our state has done a pretty good job of getting the virus under control. Now it's started to trend up a little bit. We're surrounded by states that have kind of been reservoirs of virus where they didn't have as strict controls. Businesses are opening, but they're suffering. I know lots of businesses who are. I have a friend who has an events and sort of leadership event training business, and those things have totally shrunk to almost nothing. If you own a performance space, there's just no way to make it work. Restaurants are trying to do takeout, but it's not the same. And there are a lot of consumers out there who don't have the backstop of unemployment or federal support that I do think it's going to lead to more evictions and put a lot of pressure under people. So, we got a lot riding on federal government showing some backbone here in supporting all these local entities. They've done a good job in keeping places closed and containing the virus. One thing I wanted to say is that we in Chicago have come under criticism from the president for trying to attack the city for outbreaks of violence. I just think we should not attack people for where they're from. And conditions on the ground are actually pretty good. One of my high school teammates on my baseball team, he runs he runs a big small business down in Englewood, which is one of the poorest neighborhoods in Chicago that came in for a lot of negative reporting. And I just wanted to visit his business. He wasn't answering the phone, and they're doing fine. They're running 7 days a week. They said we can't keep up with all the work we're getting at our hardware store and our bike shop. So, I just urge everyone out there to look beyond the headlines. Chicago is a huge place. Just about all the neighborhoods are going along just fine. And the headlines can sometimes be very deceptive on this. I think our mayor is doing a great job in speaking for our citizens in keeping this under control and reminding people that looting is not unrest. Like, looting is different from unrest, and I think the looting that's being done by a very small group of organized people, and I think the mayor will get to the bottom of that. While we got to address all the other social ills that are out there that are very real, but let's do it legally.
So let me ask the next question, and maybe the last because we're running out of time.
Yep.
Are you an assessor or are you a mayor?
I'm an assessor. Well, we have a great mayor. Her name is Lori Lightfoot. She's the mayor of Chicago, and we got 130 other mayors in Cook County. I'm the assessor. Now, we can, through our work, we can actually shift, hundreds of millions, billions of dollars.
I should have asked that in a better way.
Across the city
are
in
you
the way that the
a
mayor
future
can.
mayor?
I live in Oak Park. We got a great mayor in Oak Park. I love our mayor a lot. Remember, I come into this loving the valuation challenge of our job. So we got a lot of work to do here, and I'm going to stick to my knitting.
That was my headline grab question.
There we go.
So well done.
All right. Thanks, Joe.
I'll bring
give
this
it another
back.
go another time.
I'll bring this back to CRE for one more question, which is in your former life, you managed money, you had a vast array of property types you were looking at. Play Sam Zell for us right now, another famous Chicagoan. What would have you licking your chops right now because valuations are depressed and you think that they'll bang us back quickly? And what are those situations where you said, run as fast as you can away from that type of thing?
Well, let me speak for Cook County and what we see in this area. Chicago and the Chicago area is continually reinventing itself. It's got a broad-based economy, and I just think there's so much opportunity in industrial. My old job, we invested in world-class industrials in Scandinavia and Switzerland and Germany and Japan and Taiwan, and these are high-wage countries. And industrial is like turbocharges these all sorts of urban areas there. And I think I can see this starting to happen in Chicago. We've got a wonderful infrastructure base. 6 Class 1 railroads are coming through here. Airports, once they start functioning, again, really widely educated people. It's a logical place for sales networks and for clustering to happen. I think there's terrific opportunity in industrial all over the Chicago area. And when people actually look in the city of Chicago, property tax rates aren't that high. And there's a big base that can grow if we know that assessed value in the city of Chicago is going to grow. And if industrial assets are relatively fairly valued as they are, I think there's a really good outlook from the tax side for industrial assets too. That's just putting on my investor cap, and I think there's a lot of smart money out there doing stuff in industrial too.
Well, if you find any 12 or 15% cap rate warehouse facilities, distribution, Amazon facilities, you'll let us know.
We'll tweet it out and we'll say, we found it, 16%, who wants it?
Well, with that, we will close this special podcast. Fritz, I think we'll hear more from you in one way or another. So thank you for joining us and sharing what you're seeing on the ground at Cook County. Thanks to our producer, Keegan St. Ange. Join us later this week as we look at what happened during the week and how it may be impacting you. If you have a comment, send us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the Trepp Wire podcast with your favorite provider. As always, thank you for listening and stay well.
All right.